Welcome back. Previously, we were discussing about some of the methods that were used by the decision maker to take decision with regard to investment in projects and fixed assets. And we were dealing some of the methods that actually comes under the main heading traditional methods. Let us go to the next section or category, otherwise known as modern methods or statistical techniques. Modern or statistical techniques, otherwise known as quantitative techniques. These methods are based on mathematical or statistical principles. These methods are generally considered as more reliable method when it is compared with the traditional methods. So let us discuss in detail some of the modern methods. First one, sensitivity analysis, otherwise known as what if analysis. This is a widely used technique for analyzing risk in investment decisions. It is a non-probabilistic approach to allowing for risk and uncertainty in project appraisal. This is a technique of measuring the change in the profitability of a project due to change in factors affecting a project's cash inflows. Important factors affecting cash inflows are cost of capital, price of fixed assets, project's life, rate of inflation, rate of return, present value factor, etc. The sensitivity analysis examines how sensitive the NPV is to changes in key variables such as capital cost, sales volume, variable cost, project life, etc. As we have mentioned earlier, in this method also you will be using NPV method for finding out the project, which project has to be selected. So if a small change in one factor results in a major change in the profitability or rate of return of an investment proposal, the project is considered sensitive to that factor and more risky. A less sensitive is better than more sensitive one. The sensitivity analysis can be used through NPV or IRR method. So in sensitivity analysis, we will be analyzing each investment with regard to change in each factors. So because of change in various factors, there will be changes in the cash flows, and the cash flows, change in cash flows may be wide changes and there will be small changes. So inflows that is suffering wide changes is suffering from more risky factors. Small changes means less risky factors. So in order to identify that, we will be using three different situations. Cash flow estimates are made under three different assumptions. That is, pessimistic approach, otherwise known as cash flows are estimated under negative conditions of the future. Most likely cash flows are projected under normal circumstances, whereas optimistic cash flows are estimated under the positive conditions of the future. So these cash flows are discounted by a discount rate and NPV is calculated. That is natural because in NPV you need to find the discount factor so as to find the present value factor. Then only you can identify NPV. NPV explains how sensitive the cash flows are in these three situations. If the NPV under these three situations differ widely, it indicates the risk is very high. If the variation is small, it indicates lower risk. That is how you need to take the decision. Let us discuss some of the merits and demerits of sensitivity analysis. Sensitivity analysis gives about the sensitivity of a project, in the sense that how sensitive the project are, how the project is affected by the changes in the variables. Variables means change in the external factors or internal factors, or cost of capital or cash inflows, discount factor likewise. And it gives a clear glimpse about which factor causes the change. It helps to locate the impact of risk on profitability. It helps in identifying what is the reason that led to the change in the returns. It may be due to cost of capital, or it may be due to rate of return, or it may be due to capital structure, whatever may be. It helps in identifying, pinpointing locate the impact of risk. It helps in indicating which variables are most critical. Critical means some variables may be having critical effect on the profitability of the investment. So it helps in identifying which variable is more critical and which variable is less critical. It helps in identifying areas require managerial focus, because it helps in identifying which variable that needs to be identified, which variable has to be considered, because there will be many variables, and one of the variable may be the reason for the change in profitability, and the sensitivity analysis helps in identifying which area that require managerial focus. Even though it has some of the merits with regard to application level, it also suffers from some demerits. The major demerits are it is very difficult to identify key factors and values. Some of the key factors may be neglected, because we have mentioned that it is to identify change in various variables, and variables may be cost of capital, rate of return, interest on returns, or present value factor likewise. But sensitivity analysis can't include all the key factors. Some key factors may be neglected or values cannot be considered. So it is difficult to identify key factors and values. It is not a precise technique. Exactly. None of the method is precise, and this method also suffers from that issue also. It is not a precise technique, because at some point we are taking decisions based on assumptions. And finally, it doesn't consider the effect of combined factors. Combined factor means sensitivity analysis analyzes and study the change in the profitability of a certain investment due to any particular change in any specific factor. If the change in profitability due to effect of more than one factor means if it is due to combined effect, such analysis cannot be done with the help of sensitivity analysis. So these are the demerits. So let us discuss a practical case, then you will get a clear glimpse regarding the concept of sensitivity analysis. Next case. A limited company wants to evaluate two mutually exclusive projects X and Y. Each project requires a net investment of 20,000. The annual cash inflows for each of the project is estimated at rupees 5,000. So the investment offers a uniform cash flow cash inflow of 5,000 for the next 10 years. The cost of capital is 10%. The management has done the following optimistic, most likely and pessimistic estimates of the annual cash inflows associated with each of the projects. So we need to identify these three situations. Details of the project X and Y is given. Initial investment with regard to project X is 20,000, Y is 20,000. Estimated cash inflow is, under pessimistic situation, it is 4,000, and for project Y there is nothing. And in case of most likely situation, project X is 5,000, which is already given in the question. C, annual cash inflow of a project estimated rupees 5,000. C, most likely means it is a normal situation that is specified in the question, 5,000. And finally, optimistic situation, 6,000 and 10,000. So if you go through the amounts, you can see that if the organization is going through a pessimistic situation, the inflows of project X will be 4,000, because it is said that 5,000 is a normal case. If it is going in a negative situation condition, it will earn only 4,000 case of project X, nothing in case of project Y. From that itself, we can identify that project X is less risky when it is compared to project Y. Project Y is more risky because in pessimistic situation they are earning nothing, And finally, if you go to optimistic situation, you can see that there is only a slight increase in the returns when compared to project X. But if you go to project Y, you can see that there is a double the effect. So in general sense, you can see that project Y is risky, but at the same time it is having more returns. There exists a direct relationship between risk and returns. Okay, let's come back to the problem area. How you are going to take a decision. You are required to help the management arriving at a decision. Okay, which project has to be selected. So you need to study in detail the inflows of project X with regard to 3 different situations and project Y 3 different situations, and accordingly you need to take the decision. Cost of capital 10% is given, so you have to use the NPV methods. Present value annuity of ₹1 for 10 years at 10% is 6.145. Okay, that is another case. I hope you know what is the meaning of annuity. Earlier we have learned that if the cost of capital is 10% or the present value is 10% or the discount factor is 10%, for each year there will be a discount rate. Discount rate means the discount factor. For 10%, the discount factor for the first year is 0.909, 0.826, 0.751, likewise. But in here they have taken a single amount of 6.145. Why? Because it is said that the annual cash flow for each of the project is estimated to be 5,000. The amount is equal for all these 10 years. Whenever the amount is equal, instead of finding the present value factor for each year, you can directly identify the annuity value. There is a separate table for that particular case. For that, you need to refer to the last page of the text. There will be another table given. Present value of annuity of ₹1 will be given. For each percentage, there will be certain amount. So 10% for this particular investment, in the 10th year, the annuity of all the interest rate will be 6.145. You can identify this amount another way. If you identify individual rates of each year, for first year it will be, for 10% it will be 0.909, 0.826, 0.751, 0.68. Likewise, if you find out the 10 individual values and if you add together all these, you will definitely get this amount. This is the easiest method for finding the present value factor. So that is another concept. 6.145 is also will be given in the question, or if not, you have to refer a logarithm table. Remember, for finding out this annuity value, you need to check another table, not the table which we have been discussing previously. Okay, let us begin with project X. It is said that cash inflows of project X under 3 different situations is given. In first situation it is 4,000. Its the degree of freedom, the discount factor at 10% is 6.145, and ML means most likely. For time being I am using these abbreviations. Please never use abbreviations in the examination. And in case of optimistic situation for project X, the returns is 6,000. In all these 3 situations, the amount discount factor is 6.145, because in the question it is said that it is the next 10 years. For 10 years, so we are finding out the case in case of the 10th year. For 10 years, the amount will be the same. That is the concept. So instead of finding individually each individual values, we are directly taking the individual amount with the annuity value. Next is the present value factor. If you multiply this amount with the present value factor, you will get the present value of cash inflows. 4,000 into 6.145, you will get the present value. Another case, 5,000 into 6.45, you will get 30,725, and 6,000 into 6.145, you will get 36,870. So now you have present value. And if you adjust these values for individual case, in case if the organization is going a pessimistic situation, they will be earning 4,000 for each 10 years. So if you adjust after adjusting discount factor, you will get a 24,580 by the end of the 10th year. So this is the present value of total cash inflow if the organization is undergoing a pessimistic situation. So from this amount you need to adjust the initial cost is 20,000. So the total present value of cash inflow, this amount minus this 20,000, you will get NPV. This is actually a easiest method for finding the NPV, because here we are dealing with three different situations. In the previous question we will be dealing only one case like this. So if the organization is selecting project X, and if it is in a pessimistic situation, the NPV will be 4580. If it is in a most likely situation, their present value is 30,725, but their initial cost is 20,000. So total present value of cash inflow minus 20,000, you will get NPV. I hope you are getting the concept. And finally, optimistic situation, 6,000 into 6.145, you will get present value of cash inflow 36,870. If you adjust this amount with this initial investment of 20,000, you will get 16,870. So now you have the NPVs of each different situation. Whether project X is selected or not, we can't yet to decide, because we need to identify the NPVs of project Y also. So whichever project is having the highest NPV will be selected. So this is how you need to find. So likewise you need to find the NPVs of project Y also. Project Y, cash inflows is given. In case of pessimistic, there is nothing. In case of most likely, the organization will add a 5,000 for 10 years. And finally, optimistic situation, 10,000, they will be earning 10,000 for 10 years if they are going in an optimistic condition. And the discount factor is also given. Here it is 10%. In both cases it will be 10%. So the percentage will be given. You may don't get confused. You may think that in the previous question discount factor for 10% you were writing 0.979, 0.821, 0.75 likewise. That is a situation where the inflows will be unequal. So you need to find out the present value of each cash flow for 10 years individually. But in this question it is said that annual cash flow for each project is estimated to be 5,000 in the next 10 years. That meaning is, for this, if the organization is going in an optimistic condition, 10,000 will be earned for each 10 years. That is the concept. If the amount is same, we can use the annuity value. That is why we are using the same rate for each cases. So present value of cash inflows, in first case there is nothing. 5,000 into 6.145, you will get 30,725, and in case of 10,000 into 6.145, 61,450. So if you adjust the initial investment for each case, you will get first case NPV, present value of cash inflows minus 20,000, you will get minus 20,000 because there is nothing. The meaning is our 20,000 amount is lost. There is no returns. If it is going in a most likely situation, total present value is 30,725, but initial investment is 20,000. If you take the difference, you will get NPV 10,725. Likewise, if you adjust this amount also, here you will get NPV 41,1450. So this is how you need to find the NPVs of each project if you are doing a situation of three different cases: pessimistic, most likely, and optimistic. So which project are you going to choose? Definitely you will be choosing project Y, because if you go through it, you can see that the NPVs of each case is higher when it is compared with the project X. Even though the NPV in the first case is minus 20,000, it can be compensated with other two amounts. But if you go through here, even though there is positive values, the amounts are considerably low when it is compared to project Y. And remember, if the management is a very pessimistic management, pessimistic means if they are worried about taking risk, definitely they will take only project X. Because if the management is not ready to take risk, they will take only project X. But if the management is very optimistic and ready to face anything, they will select project Y. So that is a concept. You need to take the decision accordingly. In the question, if they are specifying about the nature of the management, you have to take the decision accordingly. If there is nothing specified, you can select that the project which is having the highest return will be selected. That is the concept. So just go through it. If you have any queries, please let me know. We will discuss about the further cases in the next session.